Hello, my name's Kevin Cope, and I'm excited to walk you through a company's profit and loss statement. And you'll see on the screen an example of Austin Cycle Shop P&L. And I use the term P&L because that's short for profit and loss, and that's most often what companies use as an acronym within their own organization. Now, there are several financial statements. There are three primary statements. This is the one that probably gets the most attention within organizations. It's the one that management spends more time on. It's one that shareholders or investors pay attention to most. And it's also the one that you and I, as employees in an organization, can impact the most. So let's take a look at this P&L. And first off, I want to show you how the P&L is primarily organized. At the very top, you'll see it starts with sales or revenues. In the middle are expenses, and then at the bottom is net income, which is also called net profit, net earnings, or a company's bottom line. So as you look at this, you'll notice that there are 3 years worth of information, and that's actually required by the Securities and Exchange Commission for publicly traded companies. And it's also a useful format for individual privately owned companies to look at as well. So this, you can see, it reads from right to left. 2019, then 2020, then 2021. Sometimes it'll be read left to right. Now, as you look at this, and let's start with the top line, which is total revenue, also referred to as top line or sales. And as you look at the number, Austin's revenues, total revenues for 2021, you'll see that it's $8.3 billion. Now, you may wonder how I knew it was in millions of dollars. Well, if you look at the top left, it actually states in millions except per share amounts. And so as I look at that number, I'm adding 6 zeros to that and all the other numbers except for per share amounts as you read those numbers. Now, what do I want to see the top line doing? Well, ideally, it's going up, it's growing. And in this case, if I look at a variance analysis, you can see that Austin's sales or revenues grew 15% from 2020 to 2021. I like that. It's headed in the right direction. Now, if I only had 2 minutes, a minute or two to look at a P&L, there's 3 things I like to do first. And step 1 is to look at revenues and how fast they're growing over time. Step 2, I go right to the bottom line, which is also called net profit or net earnings. And what I'd like to see there is that line also growing, and for Austin's it is. Matter of fact, between 2020 and 2021, net income grew 28%. What I also like about that growth rate, it's growing faster than sales are growing. And that suggests that the company is getting more efficient, getting economies of scale as it grows. Now, my step 3. So step 1, look at revenues. How is it growing? Step 2, look at net income. How is it growing, and is it growing at a faster pace than sales? Step 3, I like to look at a company's net profit margin. So if I look at net income, which is $1.087 billion for Austin's, as a percent of sales, it's 13%. In other words, for every dollar of sales, Austin generates 13 cents in profit. So a net profit margin of 13%. Now, if you looked at the average company, and let's say we looked at the index, the S&P 500 companies. So 500 companies across a whole lot of, across all industries actually. Their average net profit margin is about 10%. And so Austin's at 13% is more profitable than the average company. This is an important measure to know. If you look, for example, at high-tech companies, Microsoft, Google, Facebook, they tend to have profit margins in the 20% or even 30% range. If you look at big box retailers like Walmart and Costco, their margins are about 2%. And the reason you get such a disparity, companies that sell unique products or they've branded their product as unique generally get higher margins because they can raise the price and people are willing to pay it. But if you've got companies that sell commodities, in other words, a product that you can get in many places, for example, a gallon of milk, you can buy that in many retail locations. And because it's something that's commoditized or it's not unique, those companies will sell it hopefully for a lower price. They've got to compete on price because it's the same gallon of milk you can get anywhere else. And that's why they have thinner margins. Well, back to Austin's. On his P&L, we've now looked at 3 things. And again, when I've got about 2 minutes, I look at these 3 things: sales going up, profit or net income going up, hopefully at a faster rate, and then third, net profit margin. I hope you'll do that same quick analysis for your organization. Now, if I've got a little more time, and we do, we'll go a little deeper into Austin's P&L. So let's go back up to the top, the total revenue line, and the first expense that comes out is cost of goods sold, or COGS. There's two primary expenses in that line item. You've got raw materials and direct labor costs, meaning anybody that's part of the manufacturing process or providing directly the service. When you take that out, you come to a profit line called gross profit. In this case, it's $3,700,000,000 for Austin's, and it's 45% of Austin's sales. So the gross profit margin is 45%. The gross profit dollars, $3,700,000,000. Now, do I want to generate more gross profit? Absolutely. And I could do two things. I can raise sales, or I can lower cost of goods sold. Now, below that gross profit line, you have operating expenses. And Austin lists four, which are very typical in many companies. The first one is research and development. Then you have sales and marketing, and then general administrative expenses, which include overhead costs like IT, HR, treasury, executive salaries in there, et cetera. And then below that, you have depreciation and amortization. Those are operating expenses. When you take out operating expenses, you come to the line operating profit. And operating profit for Austin's was $1,494,000,000, or 18% of his sales. Now, of course, that operating profit we'd like higher, so anything you can do to raise sales or reduce any of the expenses above that line will improve operating profit. It's also known as another term, by another term called EBIT, earnings before interest and tax. And so the next cost to come out are interest and taxes, which are also referred to as non-operating expenses. So when you take out non-operating expenses, we're back to our net income or bottom line. So far we've talked about three profit measures that you'll commonly find on a P&L. You've got gross profit, operating profit, and net profit. Or again, they could be called income. So gross income, operating income, or net income. Now, below that, you'll see some additional information which actually provides a fourth profit number. It's called earnings per share, or net income per share. And how you calculate that is you take net income, in Austin's case, $1,087,000,000, and divide it by the number of shares, in this case, 4,300,000,000. And when you do that, you get 0.25, or 25 cents per share. Now, do I want that 25 cents higher? Absolutely. And I've got two fundamental things I can do. I can either raise my net income or reduce the number of shares. And so when a company buys back its stock, you've probably heard that term, or you've heard of many companies doing that, buying back their own stock and retiring the shares. They're doing that in order to improve the earnings per share. And as you improve earnings per share, that should improve a company's stock price. So you'll also see now that you've got two terms down there. There's basic earnings per share and diluted earnings per share. Basic earnings per share includes all of the shares that exist in the marketplace. Diluted earnings per share takes all of those same shares in the marketplace and adds stock options that are worth something but have not yet been exercised. And most CEOs will refer to diluted earnings per share. That's the more conservative number. Now, I'd also like earnings per share going up, and in Austin's case, it was actually flat. Even though net income was growing, and it grew by 28% from 2020 to 2019, you can see that the number of shares also grew. So that's why earnings per share was flat year over year. Well, I hope this was a useful overview of a company's P&L, and I hope you'll go take a look at your company's P&L and learn more about how your company makes money. Thank you.